AMC stock is at the most shorted levels it has been at in all of 2022. Remember the March rally, or the August rally, or the rally that we are about to go through right now. Well, the data has never looked better in 2022 than it does right now. All around, the cost to borrow rates, the days to cover, the actual short interest, the technicals. You've never been at a better position to be long in AMC stock in 2022. That is a simple fact, and that is what we are going to talk about here in this video. And first thing I want to point out to you guys is the official short interest. This comes from the SEC itself, the focus point of manipulation that gives us these numbers. Gave us a number November 15th at 21.64%. As I reported to you guys yesterday, the estimates for the short interest went parabolic yesterday. Went up about 6%. They're up about 0.5% yet again today. Now the estimate is at 21.29%, and Ortex tends to be more conservative. They tend to keep these estimates on the lower end range, and then they'll come out and say, yeah guys, we were wrong, we just got the reported numbers, and they'll go ahead and update their estimates as well. Now that you are about to get a new exchange reported short interest number, and the estimates are going up just days before that happens, leads me to believe the short interest might actually be much higher. And just these numbers that we are purely at right now on November 15th, the short interest is the highest it's been at in all of 2022. As you guys can see, even more specifically through all of these rallies, you've never been higher than this level. For a brief moment, June 15th of 2022, you were at 21.92%, but you are sitting right at those levels here today, and I would argue the short interest is probably a couple percentage points higher. It wouldn't even surprise me if the short interest comes in at 25% for AMC at this next exchange reported data day. Now, another thing is the cost to borrow rates, in which we have extensively been talking about here on this channel basically every single day. And the cost to borrow rates have certainly not been this high throughout all of 2022. If you look at the cost of borrow average, it's sitting at 48.55%. That is typically where these shares are being lent out across the board, across Interactive Brokers, across TD Ameritrade, across Webull, across Robinhood, all these brokerages. That's your general consensus of the cost of borrow rate. Now, as you guys probably know, at least if you watch this channel, shorting stocks is risky. What do banks and institutions do with risky assets? Like a credit card, right? Compared to a mortgage. A mortgage is backed to a house. That's why it's possible to get, I mean, my second house that I bought 2 years ago was a 3.25% interest rate. Well, even at 6%, it's backed by a house. That's why you get low rates. Credit cards, unsecured line of credit, high rates. They can be adjustable as well, just depending on, you know, if it's a business line of credit or whatever it is, right? Short positions are risky, so they are almost always adjustable rate positions. And when you see your cost of borrow rates go from 10 to 15 to 20%, like we've seen throughout most of 2022, up to almost 50%, and on the higher end, cost of borrow max at 56%, that is going to hurt your position, right? I think that goes without saying. It negatively impacts the hedge funds. Now, also, what you are seeing that is very interesting is the days to cover. The days to cover continues to rally. Just 7 days ago, right? The days to cover was at 6.2. Fast forward 7 days, and it's at 7.1. Why is this happening more specifically? Well, it's because the short interest is increasing. At the same time, the volume has been decreasing, and typically what you would not want to see as an investor in AMC waiting for the squeeze is the days to cover one going down, but the volume going down and the stock going down. You have not seen that. You have not seen the stock going down correlating with the low volume. It has remained pretty steadily above that 50-day moving average, and here again today up about 1.5%. So again, a positive day and getting further away from that 50-day MA, and which we will talk about here later on in this video. But why is days to cover so important? Well, it's giving you a gauge of how hard it will be for shorts to actually get out of their short positions when they want to, or I should say when they need to, because if days to cover is really high, it's saying it would take a week for shorts to get out of their short positions, no matter what happened with the stock. No matter if it went up 100%, no matter if it went up 500% or 1,000%. That's where you turn margin calls into bankruptcies, into forced share liquidations, forced share recalls from the actual owners of AMC, the original owners of AMC. Nonetheless, the dollar amount that is currently sold short in AMC has went up about $60 million over the last 7 days. 7 days ago, sitting at $755 million. Now it's at $804 million. So you've seen a drastic change over the past week, and that's the thing that I want to stress to you guys the most. Not necessarily these individual data points, because I think those are very encouraging, and you know, we've been diving into those almost every single day, but it's the rapid acceleration of change across the board that is quite interesting to me. Like, just the 7-day change on the dollar amount is 6.55%. Estimated short interest, 6.41%. Shares out on loan and free float out on loan, not really doing too much, right? So that makes me believe that just shares have been shorted, right? Days to cover up 14.5%. Cost to borrow up 7.22%. And that utilization has stayed at 100% over the past couple months now. Can we say 6 months now? It really has not moved. There's been a lack of availability to get your hands on shares if you are trying to short AMC. If we take a look at the option activity today as well, positive order value of 55%, and you are seeing larger dollar amounts heading into AMC as of recently. And we do have a positive order value of 55%, like I said, so that is on the positive side. 5 orders totaling $6.25 million. And when you go ahead and couple the Ortex data with the technical analysis, it looks really, really good. And if you guys have heard this before, I do apologize ahead of time because I've talked about it many times, but I want everyone to be fully aware of this. But essentially, this 50-day moving average is so important because in March, you rallied 100% from breaking that level. In August, you rallied again 100%, almost, you know, perfectly 100% both of these rallies upon breaking the 50-day moving average. Back here in March, it took exactly 1 week from the break of the 50-day to the peak of the rally. And back here in August, the most recent rally, it took 31 days, almost an exact 30 days to break the 50-day, to get to the peak and to see that 100% rally. So simple mathematics here, right? I mean, divide the two, you're looking at about a 2-week time frame, and you have already remained above the 50-day for about a week now, over a week now, but just call it about a week, right? So in theory, over the next couple of days, over, you know, really the rest of this week, you should start to see some pretty big moves to the upside. As long as we remain above the 50-day moving average, I will remain in this stance and will remain bullish on AMC. If you break under that, well, that is going to be a negative thing. And just purely based off of what we have seen with AMC throughout 2022 so far, with 100% rally from the break of the 50-day moving average, like you can see right here, 100% rally. If we go ahead and take this trend line off and do it for the August rally as well, from the break of the 50-day to the peak, you were up about 109%. So if you're talking about the break from the 50-day as of right now, that would put the stock at roughly $14.50 per share if we got 100% rally from that break of the 50-day moving average. And that's not including from the lows, guys. So keep in mind, if you're doing these calculations from the lows, you're going to get much bigger numbers, right? Because the lows to the peaks, you know, are a different story. But I'm talking about just the break of the 50-day moving average. And even so far, guys, if you have been watching this channel, hopefully you have made a profit on this move. You have still rallied about 62% from the lows in which we were calling out this bounce on AMC for a while now. So that's a good reason to, number one, hit the like button, number two, subscribe to the channel, but number three, to get all of your information and stay up to date with the economic catalysts that are going to be coming out, because tomorrow is going to start a slew of economic catalysts. And first things first, I got to acknowledge, yesterday and today, you didn't have really any economic data that came out. So really, the last 2 days now have been a pre-foreshadowing of the economic data, really trying to bake in expectations. And the big data points coming out tomorrow will be the ADP employment change for November. We are expecting to add about 203,000 jobs. Last month, you added 239,000 jobs. So if you do add more than 203,000 jobs, the markets are going to fall. If it comes in under 203,000 jobs, the markets are probably going to rally. But you really need to see the jobs come in at like 100,000 or 150,000 jobs added, I think, to get a big, 2 to 3% rally. If you get jobs coming in anywhere higher than 203,000, I think you're probably going to see a big down day, because it's going to show markets, the labor market is not softening, whereas, we should be seeing quite a bit of softening at this point. So that's going to be the first important data point that will come out at 9:15 in the morning. GDP growth rate quarter over quarter, second quarter estimate for Q3 comes out at 9:30 in the morning. You are expecting a 2.8% positive reading, so I think that will also be important. And then you do have core PC prices, the estimates, the final numbers coming out at 9:30 in the morning as well. Just watch these. If there is a big change or revision, I don't really expect there to be, but there is always that chance. It's not highlighted in red. It's not expected to be a big volatility catalyst. The big catalysts are, again, highlighted in red. If you want to watch this for yourselves, tradingeconomics.com/calendar. This will give you all the important data from around the world, things that will move the markets, and for obviously America. Now, you will have Chicago PMI for November coming out at 10:45 a.m. That's a medium volatility catalyst that is expected, but right here, that's going to be one of the bigger ones. It is the JOLTS job openings for October coming in at 10 o'clock in the morning. The last month, you had 10.71 job openings. These are not jobs that were actually filled. These are open job positions. We are expecting 10.4 million job openings, so a retraction of 300,000 jobs. If it comes in under 10.4 million, that's going to be very positive. If it comes in higher than 10.4 million, it's going to be very negative for the markets. And from my point of view, I think you need to see these numbers come in way worse than expectations to get a big rally based off of, what the Fed has been telling us about a higher terminal rate, so on and so forth, guys. So there's a high likelihood of seeing a big move early in the morning tomorrow, but it's not going to come up on this trading economics calendar, but it is going to come up on the Federal Reserve calendar that Fed Jerome Powell will be speaking at 1:30 p.m. tomorrow, and you can see Wednesday, November 30th. He's going to talk about the economic outlook, inflation, and the labor market, but more specifically, the markets know the Fed's going to keep raising rates. It's pretty well telegraphed at this point. We're expecting 5 to 5.25% terminal rates. If the Fed says the terminal rate is going to be in the 5.5 to 6 to 6.5 or 7% range, that is where you could see some massive downside. And why I think you could actually see massive downside based off of that is because where the stock market has went as of recently, guys. The stock market is up from the lows. Let's go ahead and pull this up. From the lows of 2022 at 348.11 is the actual low. Stocks are up 15% still. So the Fed, from their perspective, they have room to be hawkish, right? They're not endangering financial conditions when they give us, a higher terminal rate at this point. The markets have basically been begging for this since, from the Fed's perspective, since the markets have rallied 15%. Now, if you were at the lows at 350, I doubt we would have gotten a very hawkish speech from Fed Jerome Powell. But since you're up, that's probably what we're going to get, because even if you look at this on a technical basis, and look at the S&P 500, dude, you are in this triangle corner of the markets. Tomorrow, if you break above this, you are going to go much higher. If you break under this ascending level of support we have seen since the low October 13th, if you break under this line in which we are literally right here in this corner, if you break under this, you are in for major downside. So I think it goes without saying, tomorrow will be a very monumental, important day for 2022, for the rest of this year, and heading into 2023, guys. So that is going to be all for this video. Slap that like button for me. Subscribe to the channel if you have not already. If you guys also want to trade with me live in real time as well, link down below in the description of this video. Thank you for watching, and I will see you in the next one.